On November 23rd, China's Ministry of Finance released the latest data on local government bond issuance, saying that as of the end of October 2021, the national total of local government debt was about 29.7 trillion RMB, or about 4.7 trillion US dollars. Some economists believe that an imminent crisis is on the horizon due to the sheer size of the debt. When adding corporate debts and government debts of all sorts, the local debt is estimated to be close to 63 trillion US dollars. In truth, no one knows exactly how much the local debt is. However, more signs are suggesting that it's becoming difficult to hide the local debt problem. According to international standards, the risk warning line for local government debt ratio is 80% to 120%. On October 5, 2021, Tencent Finance and Securities Times Databao jointly launched the City Debt Ratio Ranking. The research shows that most local governments in China are unable to make ends meet and their debt ratios are far above the alert line. For example, Guiyang, a city in southwest China, has a debt ratio of 929%, which is about 10 times higher than the risk alert line. First-tier cities also exceeded the risk alert line, with Shanghai's debt rate being 122%. Debt rates of Beijing and Guangzhou are both over 200%. The same research also shows that 75 of the 86 cities observed have doubled their debt ratios compared to 2019. Goldman Sachs economists said on September 29th that the hidden debt of China's local governments has swelled to more than half the size of the economy. The total debt of local government financing vehicles, or LGFVs, has grown from 2.5 trillion US dollars in 2013 to about 8.3 trillion at the end of 2020. This figure is higher than the official data released by the government and equivalent to about 52% of China's GDP. The Goldman Sachs study also found that about 60% of the money raised by local financing platforms from bond issuance was used to repay debt due between 2020 and 2021, rather than for new investment. Information from the Chinese media confirms the study from Goldman Sachs. According to a report by China Business Network, more than 85% of the bonds issued by China Urban Construction Investment Corporation in 2020 specified that they would be used to repay the old with the new. Local governments in China are administrative entities, not economic entities, certainly not legal persons. However, under the system in China, the government can endorse enterprises, collude with banks, and use government tax revenue as a guarantee for more borrowing from banks. However, the government's tax revenue isn't that much, and the guarantees aren't actually valid. It has created a gray area as a result. How much debt has accumulated due to this gray area? The matter is extremely difficult to investigate. Therefore, a Chinese economist estimates that the actual size of China's local debt is more than 10 times the official size. Why are local governments in China so heavily indebted? Does the Chinese government have a solution to the problem? Land transfer fees are the main source of revenue for local governments. As the crisis of the real estate giant China Evergrande Group worsens, many institutions have taken a dim view of the future of real estate companies in China. Jones Lang LaSalle Incorporated, a leading global real estate investment and property management firm, has made plans to sell its China real estate management business for more than 500 million US dollars.
In Chinese government's point of view, there are no single private property developers that are too big to fail. So in fact, you can say we can already see the fallout of Evergrande. And Evergrande is not alone, and Kaiser will not be the last. I will expect more smaller Chinese property developers. They may follow their footsteps. They may not be able to pay the repayment of financial products as well as US dollars denominated debt as well. So I would expect more and more Chinese property developer follow up.
According to GF Securities, land revenue, which accounts for about 30% to 40% of local general revenue, has an enormous impact on local government, infrastructure, and real estate, and is also an important source for repaying specific local bonds. In 2020, China's land revenue soared to a record 1.3 trillion US dollars, an increase of about 165 times over 1998. In the midst of the pandemic, such revenue is sustaining local budgets. But local land sales have also slowed down across China with lower volumes. Based on data from China's Ministry of Finance, Reuters calculates that land transfer revenues across China dropped by 17.5% year-on-year in August 2021, the largest decline since February 2020. Meanwhile, while analyzing more than 1,000 public notices, Reuters found that about 40% of the land parcels in China's second round of land auctions, which began in June, had been aborted as of September 30th, compared with 5% in the first round. Now, the risk of default is also increasing for local financing platforms, many of which are partnered with real estate companies. According to calculations by China International Capital Corporation Limited, the interest-bearing liabilities of local financing platforms exceeded $4.7 trillion by the end of 2018, accounting for 34% of China's GDP. However, the debt service guarantee ratio of platform companies is only 0.4 times. That is to say, the cash flow of these companies' operations can't pay the debts and interest due that year. The outbreak of the pandemic and the slowdown in economic growth have also increased the debt pressure on local governments.
三季度呢，因为受到疫情和汛情
The impact of the pandemic and flood conditions in the third quarter has slowed economic growth. At the same time, the impact on imports caused by rising international commodity prices and the tight supply of some domestic energy and raw materials have also resulted in industrial producers having a price increase when the products leave the factory. All these will seemingly display signs of stagflation. Some local governments started out with more money thanks to the local industries, for example, tobacco factories, copper and iron mines. But gradually, these key industries have been incorporated into state-owned enterprises, or SOEs. SOEs usually operate less efficiently than private enterprises. Since 2018, the bond default rate of local SOEs has been increasing year by year. Especially at the end of 2020, there were a series of defaults on industrial bonds of SOEs, including large companies such as Brilliance Auto, Zheguang Group, and Yangchang Coal Power. Many SOEs raise money boldly because of government guarantees. In the absence of transparent, neutral, and objective credit rating systems, it's difficult for SOEs to truthfully disclose information to the public. When looking up the credit ratings of these large state enterprises in default, their records were among the highest, their cash flow was very good, and the quality of their assets wasn't bad. However, they suddenly defaulted on their bonds, and before defaulting, some signs showed that they had evaded their debts in bad faith by stripping away high-quality assets through equity and asset disposals. At present, many local governments in China receive less tax revenue from local industries. Land is becoming more difficult to sell. Tax revenues aren't enough to pay the interest on the debts, and local governments end up not being able to pay the salaries of local teachers and civil servants. A normal democratic government faced with a huge deficit would be expected to cut programs, downsize staff, and find ways to shoulder difficult times. But being a red regime that tightly controls its people, it will, without a doubt, continue to maintain its huge establishment. It's foreseeable that local governments in China will keep an even tighter grip on local private enterprises and pass the debt onto them. In China, private sector operators can't make money unless they work with the government. The government contracts the projects to the enterprises, and when it doesn't pay because of financial difficulties, the enterprises are the ones who go bankrupt as there is no way to sue the government. Many businesses resort to the practice of defaulting on wages, especially for rural workers who are at the bottom of society. The workers turn to the government for help, but the government ignores them. In other words, it's the common people who will pay for the debts of the local government in the end.
哦，桃花源炸嘞，你也忍不个牙，给它炸开了。
Moreover, local governments are using fines as a major source of revenue, and the Chinese people are faced with more fines and penalties of various kinds. Among the many actions taken by the government attempting to address the debt problem, borrowing more money is going to be a major route. On October 12, 2021, the Shenzhen government announced that it had completed an offshore RMB local government bond issue of 5 billion RMB, or 783 million US dollars. In a November 23rd release, China's Ministry of Finance announced the issuance of 6.5 trillion RMB of local government bonds across China from January to October 2021. In other countries, it may be a well-traveled path for local governments to stimulate the economy and real estate development by raising debt. Following the normal mindset, it's feasible to use other people's money to develop the local economy and then pay it back. But in today's China, as analyzed in previous episodes regarding the overall economic environment and the real estate crisis, the path of raising debt is very dangerous and will likely lead to a snowballing of local debt, resulting in vicious inflation. Investors who invest in the Chinese government need to think about this question. Is there any sincerity in local Chinese government officials to pay back the money in the future? Is the central government worried about the local debt problem? The answer is yes. But the reality is the central government can't help local governments with their deficits, and it can't restrain local governments from unscrupulous and massive borrowing. Under this system, local governments borrow even more recklessly. The Xi Jinping government has seen that the rapid development of China's economy over the past 30 years or so has been based, to a large extent, on a high level of debt. So this central government is trying to drastically adjust its debt policy and no longer tolerates false prosperity through debt, a move that will also have an impact on the global economy. But it seems that all these measures have come too late. As we can see, Beijing's biggest concern now is the systemic financial risk, that is, damage to the financial system as a whole or in part, leading to a disruption of financial services and a substantial negative impact on the real economy. Local government debt is part of the overall systemic financial risk, in addition to non-financial corporate debt, residential debt, and the business of small and medium-sized financial institutions. These types of debts are closely intertwined, creating a complex mix. Since 2020, China's systemic financial risks have increased under the quadruple impact of the downward economic growth, continued real estate control policies, the outbreak of the pandemic, and the escalating China-US rivalry. At present, what's on the mind of the Beijing government is if there is a problem with state-owned enterprises, real estate companies, or local financing platforms, and the local government doesn't have money to rescue them, then Beijing would rather let these enterprises go bankrupt or close down than drag the banks down to avoid systemic financial risks. It's foreseeable that in the future there will be more and more news about the bankruptcy of Chinese enterprises or companies.